Hey, welcome back. Like many of you, I work a normal 9 to 5 in Singapore and I invest on the side. I don't have time to stare at charts all day, so I rely on simple frameworks that keep me calm when markets get noisy. Today, we are talking about gold and silver because even when prices pull back, the bigger question is, have the real drivers changed? In this video, I will share a framework I use. The 4 types of inventory that explain why gold behaves like savings and silver behaves like a strategic material. This is Think Wealth 6789 and welcome to my channel. On January 16, 2026, metals pause after spring. Well, let's anchor this in what just happened last week. Gold slipped slightly after hitting record levels earlier that week, and silver also pulled back. Reuters reported gold was down on the day as the US dollar strengthened after upbeat US data, and silver was still up strongly on the week despite the dip. If you check end of day spot prices, gold was around $4,610, while silver around $91 just last Friday. However, as of today, January 19, Monday, the price continued to climb to $4,660 plus dollars for gold and $92 for silver during Asia market opening hours as we speak. Before anyone panics, this is normal. Markets don't move in straight lines. So the useful question isn't why did it dip last week and rise this week? It's what inventory story is behind gold and silver in 2026. Most people ask, what price should I buy or sell? I think the better question would be, what's the scarcity in the market? Most investors always ask this type of question, but price is the last thing to move. A better question is what's available and what's demanded right now, and what's the source volume. That's what we need and why we need the 4 inventory framework. And here's the framework. Gold and silver are both precious metals, but they are priced by different forces. Once you separate stock from flow and storage from consumption, the picture gets clearer. First, above the ground, stock. What exists? Gold is famous because most of the gold ever mined is still with us, stored in vaults, jewelry, or reserved. It's not really used up in a meaningful way. Silver is different because it has a bigger industrial role. Some silver is recoverable, but a portion gets dispersed into products where recovery is costly. This isn't about hype, it's about how the metal behaves. Gold behaves like long-term savings, while silver behaves like saving plus industrial input, in my opinion. Number 2, tradable inventory, which is what can be sold quickly. And tradable isn't equal to total. This is where many people get confused. Something can exist but not available, like collectibles, heirlooms, or items held tightly. For investing, the practical questions is how much is in forms that can be bought or sold efficiently, like bars, coins, exchange inventories, ETFs, and vault supplies, just to name a few. That available portion is what moves price fast. Number 3, industrial consumption flow. What gets used up? Silver is the most conductive metal, so it shows up across modern tech, electronics, solar panels, EVs, data centers, and defense applications. Here's the key. When demand is industrial, it tends to be less price sensitive than jewelry demand. If a component needs silver for performance, you don't always substitute easily. That's why silver often moves in sharp bursts. It's part precious metal, part industrial commodity. And number 4, policy and institutional demand. Gold is heavily influenced by central banks and reserve policy. Silver can be influenced by industrial policy and supply chain security. And this is where current events matter. In early January, the US announced an operation that resulted in the capture and arrest of Venezuela's leader, Nicolas Maduro. That's not a small headline. Shortly after, major trading houses were involved in the first US sales of Venezuelan's crude under new plan, and the story raised political controversy because of donors' connections. Why does this belong in a gold and silver video, you ask? Well, because when geopolitics heats up, gold tends to attract defensive demand. Not because gold is magical, but because it's globally recognized, liquid, and not tied to any one company's earning. So, when gold pulls back on strong US data like Reuters described, that doesn't automatically break the story. It can be profit-taking or dollar strength. Use this simple lens. If the inventory forces hasn't changed, a pullback is often a reset, not an ending. Now, silver has an extra twist. Supply doesn't respond quickly. A large portion of silver production globally is tied to other metals, so supply can be less flexible in the short run. That means demand shocks can create sharper price moves up or down. This is not a promise of higher prices. It's an explanation for volatility. So, how do you use this as a normal investor? I separate them by role. For gold, I treat it as stability and insurance. It responds to current confidence, geopolitics, and reserve behavior. As for silver, I treat it as higher volatility, higher narrative sensitivity as it reacts to industrial cycles and supply tightness. Then I ask, which metal fits my risk tolerance and time frame? Remember this. Gold is mostly stored. Silver is more consumed. Prices are moved by what is tradable, not just what exists on paper. And as we speak, I actually just purchased 1 kilogram of silver. I hope it will shoot up to 10 times of what the price is. Well, we have to make the best bet, right? And again, this just a disclaimer, this is not any financial advice. Always do your research before you make an investment based on your risk appetite. And if you think this helped you think more clearly about gold and silver in 2026, remember to like the video and subscribe to Think Wealth 67889. I'll keep sharing simple frameworks that help everyday investors stay calm and make better decisions without the noise. Thanks for watching and see you in my next video. See ya, bye.